Welcome back to The Explainer. So glad you're joining me today because we've got a truly fascinating market paradox to unpack. We're going to be looking at the Q1 2026 financial results for INDI Semiconductor. Now, this is a company sitting right at the absolute heart of the automotive tech revolution. And today, we're dissecting exactly how they're balancing these massive billion-dollar growth ambitions against some pretty stark financial realities.
Okay, let's dive into this. Think about it. How does a company that's losing over $47 million in a single quarter manage to keep Wall Street analysts so incredibly bullish? It feels completely counterintuitive, right? Usually, when you see cash burn that high, you expect investors to just absolutely panic. But as we're going to see, the semiconductor market, especially when we're talking about the automotive sector, well, it plays by a slightly different set of rules.
The current financial reality here is really a tale of two metrics. Look at the top line. Q1 2026 revenue came in at $55.5 million. Honestly, that's effectively flat year over year, just a tiny 0.67% bump. But then, you look at the bottom line, their net loss actually widened significantly, going from $37.2 million last year to $47.1 million this quarter. So revenue basically stayed still while the losses accelerated.
To make sense of how this all fits together, here is our roadmap for today's explainer. We're going to cover the Q1 2026 reality, why analysts are bullish, the ADAS growth engine, expanding through acquisitions, mounting debt and leverage, and finally, the path to profitability.
All right, let's get right to it with Section 1, the Q1 2026 reality. Stripping away all the market narratives for a second, the absolutely critical metric to watch in their SEC filings is operating cash flow. The core business burned $22.1 million in cash this quarter. That cash outflow is a glaring indicator that INDI Semiconductor is still very much in a heavy investment phase, They just aren't self-funding yet. They're building out the infrastructure and the technology for tomorrow, and they are paying for it heavily today. Oh, and you can also see that net loss per share widened to 21 cents.
Which brings us nicely to Section 2, why analysts are bullish.
Because despite those really rough baseline numbers we just looked at, institutional analysts are definitely not running for the exits, 100%. That striking number is the bullish to bearish ratio among analysts reviewed heading into this earnings print. Major firms like Roth MKM and Craig-Hallum, they've actually reiterated their buy ratings, with Roth keeping a $7 price target. So why? Well, they aren't looking at the current $47 million loss. They are underwriting the operating leverage that's going to kick in once the company scales up. In their eyes, these negative margins are completely temporary.
So what's driving that scale? Section 3, the ADAS growth engine. And this brilliantly illustrates exactly where INDI is at right now. Wall Street's optimism pretty much entirely hinges on ADAS, Advanced Driver Assistance Systems. But look at this revenue mix. Right now, INDI is overwhelmingly a hardware company. 95.2% of their revenue comes from physical products. Less than 5% is coming from software and other sources. And as we know, hardware usually has way tighter margins than software. So for INDI to actually reach profitability, it is absolutely crucial that they shift this mix. They urgently need to transition their camera-based in-cabin monitoring and ADAS deployments into those juicy high-margin software revenues.
Now, here is the magic number that keeps analysts so incredibly excited, the $6.3 billion backlog. INDI has this massive, sprawling pipeline of design wins. So the central question for the stock isn't really whether the market opportunity is there. It's purely about execution. How fast can they transition these new programs, especially the software-rich ones, from the development phase into actual billable production shipments?
Let's look at how they plan to pull that off in Section 4, expanding through acquisitions.
See, to fulfill that massive $6.3 billion backlog, INDI is aggressively buying up the technology they need. But when they make these acquisitions, they rely heavily on a specific financial structure called contingent consideration, or what you'll usually hear called an earnout. It's basically an additional payment agreed upon when one company buys another. But the catch is, it's only paid later if specific future performance targets, like hitting a certain revenue or production goal, are actually met.
Let's look at a real example with the recent acquisition of Emotion 3D. By using the step-by-step earnout structure, INDI brilliantly shifts the execution risk right back onto the sellers. They don't just hand over a pile of cash on day one. Step 1 offers a $4 million payout, but only if Emotion 3D hits a specific 2025 revenue target. Step 2 unlocks another $6 million by 2027. And Step 3,
That's just a bonus for overachievement. It perfectly aligns everyone's incentives toward actual, tangible growth, rather than just cashing out and walking away.
Of course, growth isn't free. Section 5, Mounting Debt and Leverage. Acquiring all these companies and funding heavy R&D takes serious cash. To stay liquid, INDI relies heavily on convertible senior notes. Think of it kind of like a loan issued to investors that ranks really high in priority for payback. But it comes with a twist. It allows those investors the option to turn that debt into companies' shares later on if the stock price goes up. It's a clever way for companies to borrow money at a slightly lower interest rate simply by offering the upside potential of equity.
Let's move to the timeline and see how this builds a very specific debt situation for them. In Q1 2026, they issued $170.5 million in new 4% convertible notes. But crucially, they used part of that new cash to immediately repurchase $104 million of their existing notes that were due in 2027. By doing this, they successfully extended their runway, effectively pushing their major debt maturity all the way out to 2031. It buys them time for sure. However, actually, scratch that. It doesn't just buy time. This refinancing maneuver also increased their total gross debt load to $427.6 million.
Which brings us to our final act, Section 6, the path to profitability. So let's recap. We've got flat revenue, a massive backlog, growing debt, and aggressive acquisitions. To turn this whole complex machine into actual profit, analysts are watching a few specific execution milestones like a hawk. First up, sequential gross margin improvement. Since their revenue is currently flat, even tiny incremental improvements in their gross margin are going to compound beautifully and shrink those operating losses. They also absolutely need supply chain normalization. They need to actually scale those high-margin software revenues we talked about earlier, and they have to carefully leverage the $174.4 million in cash equivalents they're currently holding on the balance sheet.
Oh, and as a quick aside on their balance sheet, there's this really interesting clause in those new 2031 notes called a make-whole fundamental change. Essentially, if INDI gets bought out by a larger player, this contract clause requires INDI to compensate those note holders so they don't miss out on their expected future benefits. It's just a key piece of jargon to keep in mind. It protects investors if the entire landscape suddenly shifts.
So the crucial point is, all of these moving parts, all this debt and investment, it all builds to management's ultimate objective, achieving a $1 billion annual revenue run rate by late 2026. $1 billion. That is the massive scale they are aiming for. When analysts see a goal like that, driven by the inevitable, unstoppable adoption of ADAS and cabin personalization, well, today's heavy cash burn just looks like a necessary down payment on tomorrow's market dominance.
Which leaves us with this final burning thought. Do the very real execution risks, the $427 million in debt, the negative operating cash flow, the absolute reliance on successfully transitioning hardware into software, do they outweigh the potential of capturing a slice of a $48 billion automotive semiconductor market? It is literally a textbook growth versus profit paradox, and how INDI executes over these next few quarters is exactly what will write the answer. Thanks so much for watching this explainer. Keep your eyes glued to those margin improvements, and I'll catch you next time.